Hey, welcome to Exchange. This is part 2 of the Stryker series. If you haven't seen part 1 yet, be sure to see that first, but let's dive into it right now. So this is another very important slide. So this is the idea of Goodwill impairment testing. So basically the idea is, Goodwill is the overvalue you pay for an acquisition target above the net asset value on its books itself. And that needs to be periodically tested. Hey, is this asset still worthwhile? Is it still generating returns we expected? Is it basically on that glide slope for growth that we expected before we actually acquired it? Or if it's not, we need to mark those Goodwill assets down, which just happens to every single company. This is a very normal process. Sometimes they're marked down. Sometimes they're potentially, it happens all the time. It's not anything, it's like malicious or anything bad. But they're doing more quantitative testing overall to make sure it's actually valid, which this is surprising. I mean, they might be some pressure from their auditors, potentially, whether who their auditor is, to actually mark down some of these Goodwill assets down pretty far. The problem for Stryker, though, looking at their actual 10Ks, this is their actual the current assets and total assets. You see Goodwill right here, this line, it's about $12.9 billion. Total assets, it's about $34 billion. I mean, you're talking right there, massive Goodwill overall charge. So about 37% of the company or assets are Goodwill itself. So even a small markdown on Goodwill will drop your assets down, which if you drop the assets down without raising the debt, it's going to actually drop the equity value down too with it, which that's what danger for a Stryker potentially. If their auditor gets a little nervous, starts impairing Goodwill a little bit, you could have potentially a larger asset write down and or following an equity drawdown too, which would affect the entire board, which would really negatively affect shareholders. So this is the family office and also the family money. So the Greenleaf Trust and Rhonda Stryker Holdings. You see in 2015, they had about 15% stake in the company. Now it's down to 11.3%. Year over year, it's just been dropping and dropping and dropping. But typically, if you see like, hey, a strong company, it's family owned, they have strong, confidence in it. You want to see either that maintained that level or potentially increase. But I mean, it's been dropping enough where they're trying to pull their cash out because they think that maybe the valuation is too high, or maybe they think it's potentially a local peak where, hey, they just want to get out and basically hedge themselves potentially for a downswing, which could be possible given what we've seen already. So, I mean, given all that we've seen, you think, hey, maybe the company might be a neutral rating. Maybe it might be potential some sell side. But, I mean, Wall Street itself is very, very, very bullish. You see, the only sell side analysts that are actually saying sell is actually Goldman Sachs and Morningstar down here. But even then, the buy side analysts are saying, hey, strong buy or outperform or whatever else it might be. They're really only calling for about a 5% upside. So the upside is not that high for the actual buy side. Again, this really is explained by looking at like potential M&A activity, the debt markets. Stryker is very, very involved with investment banks because they do a lot of overall deal transactions, and it's one of those things where it's kind of like it's not nefarious, just it is what it is. It's like, hey, if you get basically a sell side rating, you're like, hey, Stryker's a strong sell, don't own the stock, it's crap, whatever else it might be. If you're Stryker executives, you're not going to like, let's say like BOA says that, you're not like, hey, BOA, you want our business? Absolutely not. Give us a buy rating. Let our investors know that, hey, we're a strong stock overall. Otherwise, you're not getting our debt deals and or potential new M&A deals down in the future. And then finally, they pulled the Bloomberg Terminal here, looking at basically the free cash flow projections for future earnings, also the current share price here. And you see this basically this red liner here. It's looking like a cliff. This is their free cash flow estimates going down, which is surprising. Typically, if free cash flow drops, you see the equity value drop with it, or if free cash flow rises, you see the equity value rise with it too as well. What we're seeing right here, which is surprising though too, is free cash flow estimates are dropping, but the equity, it's just pegged at that 260 mark. Which is almost, it's just weird because it shows either institutions are not selling or not selling in large enough quantities to actually move the price down too far. But I mean, if it does fall, if it does drop, it's going to drop fast, potentially basically chase this free cash flow estimates down, especially if they have a bad earnings miss or even a bad restructuring charge or potentially even a bad write-off. I mean, it could be very, very bad and get very volatile very fast, which I think Spruce Point's kind of on that pathway. The problem there is just timing. I mean, you just don't know for sure whether it's, a month, 3 months, a year from now it actually hits. But I mean, it will eventually hit if it stays those basically like suppressed levels for long. So this is the last slide in the deck, as you've seen based on the various points you mentioned earlier in the video, but Spruce Point sees a 35% to 75% downside risk there. And they basically did their valuation on revenue multiples, EBITDA multiples, which EBITDA is earnings before interest, taxes, depreciation, amortization, also operating cash flow. So low case, high case scenarios. So low case for the revenue is negative 52%. The EBITDA multiple low case is very, very bad, negative 72%. Low case for operating cash flow is negative 61%. But really the high cases there, like if things are actually turned around, they actually get some actual progress and growth, it's still a pretty strong downside risk there too. So definitely be careful overall with Stryker potentially in the long term. Long term as in this summer and this fall, and potentially moving on beyond, unless they make major changes in their operating structure and or margins overall. Hey, but that's Stryker overall. Let me know your thoughts in the comments down below. Also like the video, hit the like button down below. Subscribe to the channel for more content just like this. And that's the exchange.